investors. This video is for stock pickers and it will help you outsmart the market. Now, active investing is an art, not a science, and you, my friend, are the painter. Many people think that the market knows better, has the perfect information, and never makes any mistakes. We've all heard of the efficient market theory. Everything is efficiently priced all the time. Now let me ask you something. How does the efficient market theory explain the Warren Buffetts, the Peter Lynch's, and the Jeremy Granthams? Investors that have outperformed the market for decades. And in Warren Buffett's case, close to a century. That's a lot of time. The academia will come up with something stupid like a Six Sigma event, which is luck being involved, becoming rich once per the life of the universe. 6 times. Efficient market theory is for losers, and I believe you can do better than the market. We've all watched the news media refer to the market as if it's this super intelligent God being. That's because the news media and the trading platforms make money on constant buying and selling of securities, on advertising, deals with brokers, and so on. They are the middleman, or the croupier in the casino, always taking the fair share out of your pocket. The noise is constant, and if you look closely, it is designed to make you trade all day, every day. You have the pre-market, you have the aftermarket, you have futures, and God knows what to suck in more trades. We've all seen the news in the morning of a strong dollar causing the futures S&P 500 to crash by 50 points. Then by midday, as the indices recover, the news title will suddenly change to strong dollar causes the S&P 500 to rally. Go figure now. If you follow the news, you would have probably made 2 trades. You would have sold low pre-market and you have bought high later during the day. You would have paid fees and commissions, all for nothing. Daily activity in the market should be ignored as it doesn't reflect any changes to the fundamentals of the business you have bought into. So what is the market anyway? It's millions of individual investors, fund manager, pension funds, institutions, all made out of people. And it's hard to admit, but we are social animals, and when fear and greed are involved, you can see amazing things during your investment careers. And in order to outperform the market, you need to think like a business owner, not holder of a few pieces of paper, cold shares. In fact, every time you buy a stock, say Nike, think about it as if you're buying a part of a Nike store or pieces of the equipment in the warehouse. If, for example, you own shares in Apple and the price falls 2% pre-market, does that really mean that Apple Corporation is worth 2% less than it did the previous day? Of course not. Businesses do not change overnight, and you can take advantage of that and buy a piece of Apple at 2% discount. It is critical to have a long-term view for holding your stocks, at least 10 years. Think about this for a second. What difference does it make when the share price fluctuates this week or this month when you plan to hold a stock for a decade? Absolutely none. Now, if you trade on a daily basis as a trader, price fluctuation matter and your risk is better or more market volatility. But let me ask you something. Have you heard of a successful billionaire trader? I don't think so. First of all, you might get lucky once or twice on a trade, but in the long run, you will underperform for sure. Add friction costs like commissions, fees, and taxes, and they're going to destroy your portfolio and leave you with nothing. Look at Progressive Insurance share price. It collapsed to $68 during the pandemic, an 18% drop, and since then it's been up 2.4 times and paid you some juicy dividends. It would have been an enormous opportunity to buy and ride the cyclical wave. And does anyone remember the Volkswagen diesel scandal in the United States? Volkswagen were faking the diesel emission software to save a few bucks and appear environmentally friendly. The share price went from 25 to as low as €11 when everything unfolded in just a few months. But look at the market cap of the business. Did more than half of the business, the buildings, the machinery, inventory, and brand names just disappeared in those few months? Nope, I don't think so. People just panicked as they followed the market and sold off because of the constant news barrage. And Volkswagen ended paying up a small 2.8 billion criminal fee compared to the 60 billion loss in market value. Now, if you were an owner in the business or understood the manufacturers, you could have taken advantage of the situation. It is very important to trust yourself and ignore the masses, as they will constantly say you're wrong. So, Ibom, did Warren Buffett panic when Apple shares dropped during the pandemic? Of course not. Not only that, but he also bought in more shares on the cheap, and he made tons of billions of dollars in profits and dividends.